We sold 2 deals last year for a loss, and it was the first time we had sold for a loss. Again, we sold 26 deals for a lot of profit, and then last October, November, we sold for a loss, and we'll have other deals, unfortunately, that sell for a loss that we bought at the peak of the market.
Welcome to Cincinnati's best ever real estate investor mastermind. And welcome to the Cincinnati Real Estate Investing Show. For those of you who are listening or watching online, we are here live last Tuesday of June 30th, 2026. Fantastic speaker lined up. If you are interested in getting in a room in front of 30, sometimes 40 local real estate investors of varying experience levels coming from varying niches, asset classes, this is a great place to be the last Tuesday of every month. Our guest today is Joe Fairless, who actually started this meetup 11 years ago, if you can believe it. His thought leadership brand is Best Ever CRE. They have the longest running daily real estate investing podcast with, I'm going to say around 50 million downloads, because I know it was 40 a few years ago. They have a very popular e-newsletter, and they've also started a new mastermind group called The Inner Circle that I'll ask Joe about a bit more in a moment. He's also a partner in Ashcroft Capital. Can I say it that way? Co-founder of Ashcroft Capital that stopped counting the number of apartments when there were too many thousands. And their assets under management is in billions with a B. So he has a depth and a breadth of knowledge when it comes to especially multifamily and apartment investing that we're going to get into. The main focus of this interview is how the multifamily investing landscape is going right now, what people should be thinking about halfway through 2026. So I'd like to start, you can give a little bit more of an introduction of yourself, of course, Joe, but my first real question is, thinking as an apartment investor, what has been your focus the last 12 months, like middle of 2025 to today?
First off, great to be here, and I'm here to add value. As I mentioned earlier, this isn't about me. This is about what can I do for each of you. And so as I know you have some questions I'm sure you've come up with, but also want to hear whatever questions anyone else has too, as it allows, as time allows. Focus on Ashcroft, it's always going to be the current portfolio and making sure that the current portfolio is taken care of to the best of the ability. We started buying in 2015 and sold 26 deals from 2015 through, call it 2021, and had an average return that was really high for our passive investors. And then we're buying in 2021, turns out that was the peak of the market, and we bought with floating interest rates. And now deals that you bought in 2021, generally speaking, are worth less than what you bought them for because of interest rates and supply demand and other things. So the focus has been on our current portfolio and doing what we can on those deals, while also buying through the cycle, buying properties. Anyone hear of dollar cost averaging as an investor? You don't try to time the market, you try to buy all the way through the market cycles. So we bought 4 deals last year, 2 of them with institutional money and 2 of them with private investor money.
Quick note on Q&A. I'm good with you guys raising your hand at any point. Based on our microphone setup, I'll be repeating questions that they ask, so we have it on all of the recordings, and then I'll let you take it from there. So feel free at any time, raise your hand. Happy to have your questions. It's easy to see general headlines right now about what's happening in apartments, and there are a lot of headlines about large complexes, large portfolios having to sell at discounts where investors are losing capital. I'd like to get your perspective on what's really happening and why when it comes to property values being lower and why it's happening now.
We're part of those headlines. We sold 2 deals last year for a loss, and it was the first time we had sold for a loss. Again, we sold 26 deals for a lot of profit, and then last October, November, we sold for a loss, and we'll have other deals, unfortunately, that sell for a loss that we bought at the peak of the market. And generally, the causes for losses in multifamily would be when you buy high. Turns out at the peak in 2021, you had low cap rates and lower interest rates, and then when interest rates increased, cap rates increased along with that, therefore values decreased, and That's a problem. That math doesn't work, especially when you factor in also a really important part, and that is supply demand. Lots of supply, historical amount of supply, I think the most since the 1970s within the last 3 years whenever interest rates were increasing along with inflation. So you had multiple things factoring into that.
When you talk about supply and demand, are you talking about on the leasing side or on the selling side with your apartments?
I'm talking about on the building side.
The building side.
Yeah, so tons of supply was built.
Yeah.
Because interest rates were lower and that a lot of construction projects penciled, and they ended up getting leased up during the time when the interest rates were increasing. So you had a perfect storm of challenges for multifamily operators from 2021 to 24 if you bought with, that's from a valuation standpoint, and then if you combine that with floating rate loans, and you can buy rate caps for floating rate loans, but eventually those rate caps expire, and then when you have to buy a new one to replace that, then the price, for example, could go from $30,000 initially to $1.3 million. We saw that firsthand on a deal. So that completely annihilates the pro forma that you had originally. So a lot of lessons learned on that, and can unpack any of that.
Can you explain the price of what went from 30,000 to 1.3 million?
The rate cap.
The rate cap.
So
The rate cap.
so rate cap. So if you have a floating interest rate loan, then you most likely will have a rate cap, and the rate cap will say the floating interest rate loan is this, and the rate cap will only allow the interest rate, even though it's floating, to cap out at a certain amount, right? But as interest rates increase, the cost of the rate cap when you have to renew that exponentially increase in tandem with the interest rate increase.
And that's because of how far below market your interest rate was when you bought in 21 or 22.
Correct.
So the cost of keeping that is what went from 30,000 to 1.3 million.
That's correct, yeah.
Got it. The Cincinnati's best ever REI Mastermind is coming back the last Tuesday of this month, July 28th, 6:30 to 8:30 p.m. Go ahead and get registered for this one. We'll have a registration link in the show notes for this episode. You can also go into the Facebook group, get registered on our website. We have a fantastic speaker lined up, Ash Patel of Invest Beyond Multifamily. He's going to try at least to convince you all that you should be investing in non-residential commercial real estate. He's one of the best deal junkies I've ever met. And what I mean by that is that his ability to use what's publicly available online to figure out the viability of a non-residential commercial real estate deal is absolutely astounding. He's going to bring insights about which asset classes, strategies, neighborhoods we should be looking at in the greater Cincinnati area for his style of real estate investing. And that's Tuesday, July 28th. Go to the link in the show notes or go into the Facebook group for Cincinnati's best ever REI Mastermind to get registered, and we will see you on the 28th. How small of a property when it comes to apartments are you seeing get caught up in this cycle? This moment where they were bought with interest rates that were only fixed for 3, 5, 7 years ago, and now they're having trouble selling.
I think it's anything that's greater than a 4 unit could be, because it would be a commercial loan. And generally it would be larger properties, because if it's say a 10 or 12 or 20 unit, you might have different type of financing set up. And also, regardless of the loan type, it's when the property was purchased. Now, anytime you speak generally, there's going to be exceptions, right? Of course. I can tell you one person in the room, John Kasman, over there, I invest passively with him on a deal I think you bought in 2021, and it just sold, and it was a very good investment. So I'm speaking generally, but there absolutely are exceptions, and some of them are in the room.
If I can ask, where is that property that y'all just sold? In Florence, Kentucky, which is in northern Kentucky, the greater Cincinnati area. Leads to a question, not even a question. I want to make a statement and just get your response to it. Interest rates have gone from somewhat historic lows to definitely in recent decade highs. High sixes into the sevens, maybe the low eights for some people with some assets. Here in the Midwest, and thinking particularly about the Cincinnati metro area that most of these people invest in, and most of our listeners are interested in investing in, these interest rates have risen, but only to where our cap rates already were. So assets in the Midwest where they were already being purchased at cap rates that are, of course, closer to the interest rates now, but are still on par. So it's not like a 3 or 4 cap was purchased and now has to carry 7% debt. The Midwest is handling this moment better than other parts of the country where people were buying at lower cap rates back when the interest rates made sense.
Okay. Yeah, you said it was a statement, not a question.
Yes.
Yeah, I'll say, and an important part to that is there's rent growth in the Midwest. And in the Sun Belt, it's been flat to negative rent growth. So that's a problem for multifamily operators for the last 2 to 3 years. Now, it's projected to have rent growth starting next year, the Sun Belt specifically. But the Midwest has always been slow and steady, wins the race, whereas the Sun Belt, it was getting explosive population growth. It's now still getting population growth, and more people are still moving to the Sun Belt than they are the Midwest. But because of that influx of supply in the Sun Belt, you had a lot of rent growth, and then you have flat to slightly negative, and now you're going to have rent growth pick up again, probably starting next year. Again, depends on the submarket.
A lot of new housing coming online the last several years because those builds were started when debt was cheap. The new supply has outpaced the population growth, the new demand. The new supply has basically stopped because when interest rates went up, people stopped breaking ground. But there continues to be population growth in the Sun Belt. So why not just hold your breath until the demand catches up to the supply? Is that the only thing going on?
Oh, is that the only thing going on? I'd say that's a primary driver of the flat rent growth. It's just simply supply and demand.
So with a lot of properties in the Sun Belt that are being sold at losses for the investors currently, why not just keep them until demand catches up to where supply has gotten?
You could if the loan allows that. So it depends on the type of financing that was set up for the loan originally. If it's a 5-year loan and you bought in 2021, 1, 2, 3, 4, that's 2026, that's this year. So the loan's maturing. And if the loan's maturing in 2026, which is now, and the values are down, then what do you do? Because the property in this case would be worth less than what you bought it for. So then that's where you see operators having to do capital calls or giving the properties back.
That makes sense. Are there any questions? Yes. The question is whether or not property values for some of these are getting to the point of being lower than the current debt, where the lender is interested in working with you to protect their asset, the loan, as opposed to you selling at a loss for them as well.
Yeah, it varies lender to lender. It depends on where those lenders' funds are coming from. Do they have investors? Is it in their own portfolio? I remember from my single family days, the advantage of having portfolio lenders, so small banks and credit unions, because they keep the loan in their own portfolio and they can be more flexible with terms. Shake hands with the president of the bank who you went to college with, he's a fraternity brother of yours, or you're on the soccer team or whatever with them. That can be similar to large commercial properties. So it depends on the lender and multiple variables.
You seem concerned but not panicking, and it sounds like you have some optimism about deals that are happening now or coming up soon. Where is your optimism coming from?
I would say the important thing is to understand that real estate goes through cycles. We all know that. Everyone intuitively knows it, and if you study cycles, there's always a cycle. And the important thing is to also know what was causing the challenges, and are they going to be constants or are they going to be variables that come and go? We talked about interest rates. Interest rates very well might stay. Nobody knows. Raise your hand if you are certain what interest rate is going to be 2 years from now. Nobody. But what I'm pretty darn confident in is the supply demand, because intuitively interest rates lower, more projects penciled, therefore more construction happened, flood of supply, right? But over the last 2-3 years, interest rates higher, projects don't pencil, therefore the tap gets turned off, and there's not as much supply. So that's why, from an intuitive standpoint and looking at the numbers for supply demand, that big challenge, negative rent growth challenge, should dissipate and then turn to be a positive starting this year or next year, depending on the market or submarket. And when you can grow NOI, then you have more flexibility in what your options are. It's just when you are not growing NOI and you also have expanded cap rates, that's when it becomes really challenging.
So the question was particularly to the Southwest Ohio market. What trends are you seeing that make for viable multifamily deals? Is that fair?
I would ask that maybe you answer that.
Sure.
And the reason why I'm punting that question is my whole portfolio is in the Sun Belt. So I only invest in Texas, Florida, Georgia, and North Carolina. So I live here, but none of our deals are here.
Joe did get his start in the greater Cincinnati area, made all of his mistakes here and then sold and moved to where the weather's better 10 years ago.
Yeah, 2016 when, I moved here in 2015. But yeah, go ahead and.
Yeah, so interest rates have been at this level, steady in the 6s and 7s. If you're looking at bonus points or 1/8 of a percentage, it moves a lot. But we have not really seen the distressed sellers that other parts of the country have seen because there's simply more cash flow here. There's more NOI to the value of the property with our cap rates being higher. And so you haven't seen as many distressed sellers. You haven't seen as many screaming deals. There are fewer players. There are fewer buyers who are active in the market right now. I have primarily been in C-class multifamily where you still have plenty of bad operators. So you have properties that you can buy at a 7 cap on actuals, what's happening right now at the property, but there's so much revenue growth potential just because rents are below market. They've never been good at filling places or collecting rent that you can make good money buying properties like that, but you have a heavier operational lift. I'd say it just hasn't been as stark. If you're just buying stabilized real estate that's already performing, the returns are lower than they were before. And if that's what you're interested in, I would say you definitely need to focus on buying in the best location that you possibly can. And you want to put yourself in the position to see as much natural or market appreciation and rent growth as possible. If you really just want to buy things that are going right now and not fix problems other people created for themselves. Is that fair? Does anyone want to add to that? The point from Dylan Cook is that we have very little supply coming online. It is pacing with the population growth of the metro Cincinnati area, which is 1% to 2% a year. But all of the new supply that we're seeing is Class A, amenitized, much higher rents than the neighboring properties. We don't have that much Class A in Cincinnati because our biggest multifamily housing boom was in the 60s. Those brick bunker 4-family and 12-family buildings that when you see a 72-unit deal, it's actually just 6 12-unit buildings. That architecture hasn't changed since then. It's not going anywhere. No one's building any more of it. And most of the big money institutional buyers of multifamily have no interest in it, which leaves it for people who are buying at higher cap rates like Dylan and Slocum and John. Is that fair? There's another question. The question was whether or not you're changing your strategy moving forward now that you are experiencing some sales for a loss.
Different financing, and it's also a different time. The cap rates were 3.5 or so, and now they're 5.5. So different market cycle too. Rent growth assumptions are based on the market and submarket, which, like I mentioned, there's flat to no rent growth projections for this year, and then next year it start to grow. But the primary two would be cap rates and what they're purchased at and financing.
Are you still buying the same type of asset in the same market that you were 5-6 years ago, or has that changed?
You can actually get Class A deals at good pricing right now. So there's really not a market for Class C deals. So there's not a buyer's market for Class C deals. There's an opportunity for that as a buyer, but we wouldn't buy Class C deals right now. So if you are into buying Class C deals, then you won't have as much competition, and that would be in Cincinnati or other markets. The reason why, though, that there's not a lot of buyers for Class C deals is because I don't think anyone knows when the bottom will drop for Class C. I think the bottom's dropped for Class B, and I think very confident in Class A because we bought a deal in Orlando right outside of Disney in August of 2024, and we bought it at a 5.5 cap, 2021 construction, beautiful property, 315 units. You can see the fireworks every night, the Disney fireworks from one of the buildings, and we bought it at a 5.5 cap. Cap rates have compressed to a 4.8. So we bought the right property at the right time, we believe. We still haven't sold it, have about 3 more years on the hold with fixed interest rate debt on it. But if we had bought a Class C property in August of 2024, I don't know if it'd be worth what we bought it for. And if we bought a Class C property right now in 2 years, I'm not sure if it'd be worth what we bought it for. So it's interesting dynamic. You've got institutions chasing after Class A deals because they'll always trade, generally speaking. Class B, you still got the value add. Class C, there's really not a market. So it is an opportunity, but you've got to tread carefully there.
I wouldn't say that Cincinnati is all that different, just that we have a lot less Class A and Class B inventory. And Joe wrote one of the books. This is not the by the book definition of A, B, and C class. When I think about C class in terms of the buildings, I'm thinking about the brick bunker construction that actually started in the late 1940s. And then until you get to about 1978, that's C class. And after 1978, it starts to feel like B class. Not only because the mechanicals improved, because code improved, but also because the floor plans started changing. You started seeing more central heat, central air instead of boilers that just get converted into electric baseboards that are uncomfortable. I'm rambling. We're going to be recording a special episode of the Cincy REI show here soon with guests who get to decide what we talk about, any topic they want within Cincy REI, and ask us any questions that we'll answer with full transparency. If you want to be one of those guests, it's really simple. Go to your favorite social media platform between Facebook, Instagram, and LinkedIn and send out a post that says you listen to the show, you like it, share that you're a fan of the podcast, tell your people that they should listen to it as well. Put a link to the podcast in your post and tag us in it, the Cincy REI show account on your preferred platform. And when we see that, we'll DM you an invite to find a time to schedule this recording with us. We'd love to have you. Hope to see you there. Let me get back on topic. You're not going to see that the cap rates have changed all that much for C-class multifamily in Cincinnati. What you're going to find are the opportunities to purchase properties that are not performing and to out-operate your predecessors. So that what you're buying is a portfolio that's generating maybe $50,000, $55,000 a month in revenue, and all you have to do is treat people well and actually fix things when they have problems, and you'll get to $70,000 a month in revenue. And you haven't done significant improvements to the property, you're just taking better care of the tenants in the buildings. And that's 15 grand a month that you just generated for performing better, operating better than the predecessors at that property did. That's where the opportunity really is in C-class, and making sure you're buying those opportunities to add value and increase NOI.
I just want to be clear on what it was that compelled you to sell here. If I'm understanding it, you bought these things in 21, 22, probably a little bit high, got a loan that wasn't quite right. That loan ran out, and the fact you couldn't renew the loan, couldn't generate enough revenue to continue holding it. Is that what compelled you to sell instead of holding on to it and just trying to let the price come back up?
Eric is asking for more specifics on the reasons why y'all decided to sell for a loss on the property that sold for a loss.
Bought at a lower cap rate than what cap rates are now. NOI didn't grow as much because of flat to negative rent growth, and loan matured. Therefore, values weren't worth what the either close to or what the debt was, and so just need to sell.
And as far as trying to hold on to it until the values came back up somewhat, was not an option.
As far as, yeah, I'll repeat it.
No, I was going to give a follow-up answer actually, that in terms of, in order to keep the loan, given that interest rates had risen significantly and the property value had decreased because of cap rates increasing. Again, at least on the Cincy REI show, when our listeners don't understand the relationship between NOI and cap rate, they just pause it and go Google that. We're not going to slow down to explain all of these things. But the loan ballooned, it had to be repaid. And in order to renew it at the current interest rate, the rate lock is millions of dollars, and the property is not going to be given a new loan at the same valuation. You're looking at some way that you have to recapitalize, either to pay for permission to keep the loan or to bring in more capital so that you can effectively borrow less on your next loan. And so the question that's being asked here is, do we recapitalize this deal by injecting more money into it, or do we sell for a loss?
And we didn't think it would. We didn't have confidence that it would gain the value that it needed to recapture the money the new money that would have to be put in.
Let's take a step further with it. If you had a longer term loan that had to be recapitalized, then you would have possibly been in a position that you longer than the value came back up, right?
That's correct. The value you'd still have a reckoning depending on, unless cap rates compressed and grew. Because regardless of how many years, you'd still have to have a valuation that's higher.
Yeah.
But yes, you would have more time.
My turn, guys. I'm going to take the question, and you guys can raise your hands. I did not start doing deals large enough that I was raising capital from passive investors until the interest rates were already high. I've only bought deals where they make sense with the interest rates in the 6s or low 7s. We've been in the 6s thus far, thankfully. There is now much more of a stigma around real estate syndication than there was 5 or 6 years ago. And when I talk about, especially in online forums among real estate investors or real estate investing adjacent service providers and vendors, there are a lot more people saying, I know someone who invested in syndications and lost money, don't do it. Just openly Reddit style to everyone who's posting, to everyone who's reading these posts. How are you working against the stigma that the term syndication or syndicator is carrying now more than it used to?
You just have to focus on what you know and what you do, and focus on operations, focus on the deals that you think make sense, put the best projections that you have available, and I think double down on operations as much as you can. That's just gotta focus on what you can control. You can't necessarily focus on the things you can't, you shouldn't focus on things as much that you can't control. You focus on what you can.
I'm not sure that answered my question, Joe. How are you, when you're having conversations with people who are interested in investing in your deals, or I know that you have an investor relations team now, and so it may be more about the coaching that they're receiving from you and the way that they're having these conversations. How is it that you and your team are reacting to the stigma, or to the heightened stigma around syndication that there is now, by comparison to 2018, 19, 20, where it was easy to see that everything was making money, whether or not it was going to 5 years later?
You listen and you answer their question. That's it.
Are you finding that it takes more conversations, more potential investors to get to the same amount of capital raised to get a deal done? Or is it really just the same people that you would have been speaking with prior to be heard and need to have their heightened concerns addressed?
It's capital raising across the industry with multifamily is down in general. So yeah, it definitely takes more conversation.
Good questions. We're definitely experiencing a moment in the market cycle where a lot of things either are or seem to be more difficult than they have been in the past, especially for those who want to look back at 2018, 2016 and think about the market that was. One of the ways that you are helping people navigate the market of the moment is with the Best Ever Inner Circle. Can you tell us a bit about that?
Yeah, it's a growth system for operators, people who want to raise money. Dylan is in the inner circle, and I've worked with John for, I don't know how long we've known each other, 8 years. The challenges that are present now are challenges that will always be present. And that is finding the right deals, finding access to capital, and effectively operating properties. And what we've done with the inner circle, it's a growth system. It's not a mastermind really, it's a growth system. What we've done is align ourselves with fund managers. So our inner circle members, they get to do a presentation to 15 fund managers who manage multiple millions of dollars. They've raised 30 million over the last 18 months to present their deal that they're raising money for to the fund managers. I love meetings like this because I get to hang out, see people, have conversations. The problem with it is, in this case, it's once a month. I haven't come to this meeting in a while, but I have a conference I do every year. I've done it for the last 10 years. And it's great, love meeting people, seeing people, but then you don't see them the rest of the year. So what happens throughout the rest of the year? The inner circle meets 3 times a month on calls. We have a meeting in this August at the Reds Stadium, rented out a suite there, and we're all the members, it's nationwide, all the members come and meet at the Cincy and we'll meet up. So it's just a way to grow together as we navigate raising money, operating, and finding distressed deals, finding deals that you can buy right now. Because the one thing that is different now compared to a couple years from now, I think, is the amount of opportunity that you can buy relatively low based on what I said earlier with the rent that's projected to increase, therefore rent increases and rent increases, valuations increase, and you miss the market right there.
Thanks for listening to this episode. My company, Three Little Pigs, and I, we're expert operators at real estate investing in Greater Cincinnati, and we created this podcast to add value to you and to anyone who wants to listen to content like this. You can also find us all over social media if that's your preference. If you're looking to engage an expert operator for your investments in the Greater Cincinnati area, please reach out to us. Our platform includes property management by me through Keller Williams Seven Hills Realty. We're also general contractors. We have in-house maintenance and in-house HVAC, and we share the entire platform with the private equity opportunities that we create. We also take on third-party clients to operate their investments as well. The property management, the general contracting, in-house maintenance and HVAC, and we can also do a lot of the residential sales. So if you're an active or passive investor looking to partner with an expert Cincinnati operator, please reach out to us. You can find our contact info in the bio. Last question that we ask on the Cincy REI show is applicable to you even though you don't invest here. I want to know your Cincinnati hidden gems. Doesn't have to be real estate related. Love a good restaurant or burger joint, best donuts in Cincinnati kind of thing. What are the places that you love that most people even in the room here haven't heard of?
Anyone been to Blossom Donuts? Okay, only one, so you're welcome, everyone else. Just get a glazed donut from Blossom Donuts. It's the best glazed donut you'll ever have. The other donuts are good, they're not special. The glazed donut at Blossom Donuts is something special.
Where is Blossom?
It's in Montgomery.
Awesome. Joe, thank you for coming and speaking with us. Listeners, thank you as well. Crowd is trying to applaud me out, but if you're listening online, thank you as well for tuning in. Please do subscribe to the show if you haven't already. Leave a 5-star review. Share this with a friend who you know needs to hear what Joe has shared with us, and we'll see you next week. Quick disclaimer, the opinions expressed on this podcast are provided for informational purposes only. This is not an offer to buy or sell any securities, to make or consider any investment or course of action, and it is not an offer of agency from Slocum Reed or Keller Williams, Seven Hills Realty.